Good evening from Manhattan. Welcome to session 3. We have been very thankful that the weather has, for the most part across the state, has cooperated on these Wednesday evenings. We know that that's difficult this time of the year. We do have a couple of announcements that we want to make just to get started. Last session, there were several questions that came up, and you should have received an email from us with the answers to all of the questions that had been submitted. If you haven't received those, maybe mention that to your location host. And what we're going to do from here on out, we are allowing about 10 minutes to take questions and to answer those, but you guys are great question askers, and we know we probably won't get to all of those questions, but we do intend to get those back out to you prior to the following session. So we'll do that same thing this next time. So once again, this evening, you guys have eaten dinner. Our evening tonight, our financial topic is going to be on income statements, and there will be an activity that you guys will complete locally. Then we're going to come back in and review that, and we have another little small piece of a presentation that we'll do, and then you guys are going to have a local activity that will focus around family living expenses. And once again, our bottom line goal with this workshop series is that this is something that you can take back to your farm and use these financial concepts to improve upon your own farm record keeping and the financial documents that you put together, and use those to make management decisions at your own farm. So you should have, I think everybody has probably received a financial book at their location, Fearless Farm Finances. And our presentations, we are trying to mirror the examples that are laid out in that book. So there's a section on balance sheets, income statements, cash flows that'll be focused on next week. There's a section on ratios. We talked about some ratios last week. So hopefully you've received that, and will be something that you can use as a working tool with any other questions or additional material that you'd like to read on. We would like to thank a sponsor who helped us to offset the cost of these books that were provided to you. Central National Bank provided funding to help us with the cost of those books, and we really appreciate that, because that allowed us to pass out more books than we would have been able to.
Yeah, just to emphasize, we were going to have 500 participants was our goal, and that's how many books we had money for. And when we saw the registration taking off, we were able to order 700 books because of some assistance from Central National Bank. So we do thank them for their help in making sure that hopefully all of you out there receive a book.
Yeah, and just so that you guys know, our last tally number is that there's 685 participants across the state of Kansas at 32 locations participating in this this evening, or this whole financial series. So we're kind of blown away that there was this interest, but we also think that it speaks to the difficulty in the agriculture economy right now. So.
And there's a number of textbooks out there that teach farm management, but we really liked this book. It has a lot of land-grant university authors in it, but I think the biggest thing we liked about it is just the practicality of how it addressed these topics. Not from an academic standpoint, but from a real life setting standpoint. And there are a lot of topics you'll see in this book that we didn't cover. We tried to focus on the big four as we are, but just know there's a lot of good material in that book beyond what we're covering here.
Yes, so the next thing that we want to do is we want to go back and kind of regroup a little bit from last session. We last session, we maybe a little bit failed you because we wanted to keep our example as simple as possible, and we did not include a personal assets and liabilities because we wanted to keep it focused on the farm side. But we do want to show you an example of what a balance sheet looks like with personal assets and liabilities on this. So this balance sheet does look a little bit different than what we showed you last week, but this is the software that I use when I work with clients. So you can see at the top, there's current assets and liabilities. We go down to the next section and there's intermediate assets and liabilities. Go down to the next section, there's long-term assets and liabilities. Those three categories are all farm. So just below there, there's a highlighted piece that is total farm assets and total farm liabilities. And then below that is where the personal assets and liabilities are. So at the very bottom where it says total assets, it's total farm assets plus total personal assets as well. And then what it does is it takes the total assets, farm and personal, and subtracts off the total liabilities, farm liabilities and personal liabilities, and gets to a bottom line net worth. Robin, if you would scroll down to Schedule P, I'm going to show you what some of those personal assets. So this was just a sample case farm that I had worked on you can see at the top, it's pretty old, but the personal assets under that Schedule P, it has stocks and looks like it had some stocks and bonds of about $5,500. There was a cash value of life insurance in that of $17,000, some retirement accounts for $25,000, and a personal house, some personal real estate for $72,000, and that came together as all personal assets for that. And then let's scroll down to the personal loans as well, or personal liabilities, I mean, a little further down. And then, so this particular family, they had a car loan for about $15,000, and then a student loan to get to those personal loans. So that's just an example of what that looks like with the personal assets and the personal liabilities built into it. So anyways, there were a few questions about that, and we just wanted to address that right away.
Yeah, so what we wanted to make the point of last time is just we want to personal assets and farm assets separate, but it's okay to put them on a balance sheet to assess your total picture of your farm assets and your personal, but just making sure they're kept separately and documented separately.
Yeah.
Okay. So the other thing we wanted to address, and I'm going to show this a little later on, we had a lot of questions on land values after last week's presentation, and our website, agmanager.info, has a lot of information on land values at the county level. So later on in the presentation, I'm going to show some things on that website anyway, so I will show you where those are. But I put the link here just so you have that, and you can look those up afterwards if you're curious about some land values in your area. So I'm going to turn it over to LaVell to present the income statement tonight, and then I'm going to come back on when we actually analyze the statement, but I will let her take it away.
All right. Okay, so we're going to get in here right away and start talking about the income statement. So the income statement is the most common question that we hear from people is, did I make money last year? And the income statement is one of the major tools that's going to help you to better understand your farm profitability. So I think that's the question we all want to know. How did last year go? So the income statement measures the success or the profitability of the business over time. And the features that are on the income statement are the income earned and the expenses incurred to get that income, And then we can see how the business is progressing, especially as we track the income statement over time. You can actually start to build in what does that look like over and over again, and compare that growth from year to year. The income statement is most commonly completed for a calendar year time frame. I think on a traditional row crop cattle operation and a vegetable CSA type operation, I think this winter time is an ideal time frame in most operations to do the income statement. And we would actually encourage you, as you're one activity to do in January is to complete that balance sheet. As I said, I like to see them done on January 1st, and then right along with that, complete the income statement so that you do know where you're at. And you're doing a lot of the details anyways at that time to prepare for tax preparation, so it's a good way to do that at the same time. And the income statement is a good way to determine if your farm is going forward or if it's going backwards. So Robin and I honestly debated back and forth several times the best way to show you the income statement, because there is a lot of detail on an income statement, and there's a lot of pieces that if you haven't done an income statement before, you can get lost, because we're going to talk about things like accrual adjustments. And so what we're going to do, we're actually going to jump in here fairly quickly to look at the income statement and start to build it, show you some examples. But we're actually going to go step by step through this. And the first thing that I'm going to show you is how to create a historic income statement. Historic meaning we're going to look at the past year, and we're going to call that a simple income statement. So it's going to be similar to what you're doing for your taxes if you're a cash accounting. It's going to be looking at the cash income and the cash expenses. And if that is the place where you're at and you haven't done an income statement before, or a lot of this seems foreign, we're going to tell you, stay there, stay at that place and work on that and do a good job on that this time. And then maybe next year add in accrual adjustments. But if you've been working on your records for a lot of years and you feel pretty comfortable with it, then we're going to show you the next step we're going to build into that is how to make accrual adjustments. And that'll recognize inventory changes from one year to the next. And that will build in more and more. Was your farm profitable this last year? And so that'll be the next step. And then the next step after that is we're going to build in depreciation, meaning actually market depreciation, not what you're maybe doing in bonus depreciation on your taxes. And we'll talk about that as we get there. And then we're also going to talk about creating a projected income statement for an upcoming year. And so that it can be somewhat a guidepost for projecting what you think that income and expenses will be for the following year, and start to kind of use that as a management tool. So we don't want to lose anyone in this, and that's why we're going to go step by step. So you will see some repeats of slides because of the way that we're going to present this. So right now we're going to talk about a simple income statement. So this is the most simple way that you can do it. So the first thing that's going to be on there, an income statement, one of the main things we're going to talk about is income. So the farm business receipts, cash income, where does your income come from on your farm? That'll be crop sales, livestock sales, if there was crop insurance payments, ag program payments, ARC, PLC, MFP payments, any CSP type, those types of payments, and then any other farm income. The examples of other farm income might be if you do some custom hire work for other people, that might be a place where you would capture that. Then we've got to go on to the expense side. So these are all common expenses that you would see on your farm. So feed, repairs, fertilizer, seed, property taxes, cash rent, crop insurance payments, those types of things. So we're going to right away show you an example of what a simple income statement is going to look like. So as you can see, this is the cash farm income. So where did the income, when we're looking at this historic simple income, where did the income come from? There was about 450,000 that came from cash sales. There was 141,000 from livestock sales. On this farm, there was nothing in crop insurance payments for the last year. They had ag program payments of $46,000 and some type of other farm income of about $13,000. Adding all of those things together, we come up with the gross farm income on this farm of $654,000. So those would be items that would be fairly easy to find if you're looking backwards at last year, if you're looking at those. And then we switch over to the expense side. You can see line by line. I'll just pick out like the top two. Purchase feed was $21,000 on this farm, and labor hired was about $41,000. Adding all of those cash farm expenses together, we come up with a total cash farm expense of $528,000. So for the simple income statement, we have the cash farm income minus the expenses, which are cash operating expenses like seed, fertilizer, chemical, interest cost, and just subtract income minus expenses, and we get to a net cash farm income. Now, this probably seems like I've seen that somewhere before. Creating a historic simple income statement is going to look very close to your Schedule F that you are preparing, your accountant is preparing for you to do your taxes. These numbers come off of your P&L, all the things that you are recording, either manually or into QuickBooks or whatever program that you use to keep track of all of your expenses. That's where these numbers came from when you're doing a historic last year, looking backwards at last year. The only thing that the simple income statement does not have, that the Schedule F has, is the simple income statement does not have depreciation in it. So let's take it. You saw the Schedule F a couple of weeks ago when we were talking about record keeping. So we're just going to look at that briefly again. That's what your Schedule F looks like that comes with your taxes. Make it a little bit bigger. You can see the income side. Again, just like what we talked about in the income statement, there's place for your sales, your ag program payments, your custom hire, or machine things that you are doing business for, other farm income. And that is the total income that this farm took in during that year. And then on the lower part of the Schedule F is where the expenses are captured. Now, as I said a moment ago, it does consider depreciation on your Schedule F. In our income statement, on the simple income statement, we are not considering depreciation. So these two things will not match up exactly because we're not putting depreciation there. So let's talk about the reasons that you might do a simple income statement. So the positive reasons are it's very easy to find these numbers. You can either pull your P&L, what you've been recording, or just look at your Schedule F once your accountant has prepared your Schedule F, and that will have all of your income and expense items of what you did last year. It is a really good place to start with just a simple income statement, and if that is where you're at and feel comfortable with, that's perfect. This is perfectly fine. Honestly, if you're preparing an income statement, you're going to be ahead of a lot of people. And it reflects what happened with the cash accounting, the cash coming into your business and the cash going out of your business. Now, the simple income statement is not complete though. I just mentioned the Schedule F indicates what happened with the cash accounting, but it does not explain the reasons of some things that you might have done to manage taxes. So for example, maybe you held grain over and didn't sell it last year. So those things that you have no way to see that in in the simple income statement. And that's going to actually be the next step that we're going to talk about. So it doesn't reflect any kind of inventory changes, and it does not consider depreciation. The point of doing an income statement and doing it all the way to the end is to help you to better understand your farm's profitability. And if we don't consider the inventory changes, you can't really get to the profitability. But if you're not comfortable going to the next step of accrual adjustments, stay at the simple income statement, and that's going to give you great practice. And then next year, try to incorporate the accrual adjustments. So we are now going to switch, and we're going to start talking about the next level of what you can layer onto that income statement. So you saw this slide just a moment ago when we were talking about the simple. I have made red stars on the things that we're going to change to account for accrual adjustments. So for the farm business receipts, we're going to add in inventory changes, so maybe grain that was held over. And on the expense side, we're going to add in expense inventory changes. So let's take a look at that. Ideally, what we want to get to is matching the income that was produced, even if it wasn't sold in that calendar year, with the expenses, whether or not those expenses were actually paid in that year. We want to match those things, and that's what accrual adjustments will help us to do. So an example is holding some grain over to the next calendar year, but maybe the expenses were incurred the prior year. So that's what we're trying to reconcile with the accrual adjustments. So as you've probably been picking up on and you're noticing that none of these financial statements that we're talking about, they don't work alone. So one of the pieces that's important with this is if we're going to do accrual adjustments, we need to have a balance sheet from last year. So that's another argument for why we want to make have top of our mind that we want to make sure that we're doing those balance sheets at the same time each year. So an accrual adjusted income statement will not equal the net income on your Schedule F, because we are accounting for those inventory changes. I know I've said that a couple of different times, but I want you to understand that your Schedule F, which a very large percentage of Kansas farmers do cash accounting, that is different than what we're talking about here. We're talking about making accrual adjustments, which would be accrual accounting, so that we can recognize how those inventory changes impact our profitability. So whether or not, for example, that grain is held over from one year to the next. So when we talk about on the farm business receipts, the adjustments that could happen that we're going to be talking about are the difference in the beginning and the ending balances of stored crops. So one thing that you would do is you would have last year's balance sheet, and say last year at this time, at the beginning of the year, you had 5,000 bushels that you held over on January 1st of 2019, and January 1st of 2020, you had 10,000 bushels that you held over, so that you would have a gain of 5,000 bushels times the price. Let's say it's $4, that would be an increase of $20,000 that you would have an increase of. So that's what we're going to look at on here. Also, same thing with livestock, and then accounts receivable. So those will be the income items that would impact the accrual adjustments. On the expense side, it's going to be the things that are expenses. So for example, beginning and ending inventories on supplies on hand, investments in growing crops. Those things are expenses that you're incurring, and accounts payables and accrued expenses. And then also the difference in accrued interest. So maybe, for example, accrued interest, maybe on January 1st of 2019, you had accrued interest of $5,000, and this year you have accrued interest of $4,000. So there would be a change that would be recognized there. So let's dive in here and take a look. The top of this is the income statement with the accrual adjustments. The top looks identical to what it was before. We have the cash sales from crops, livestock, crop insurance, ag program payments, and other farm income. And then we have the accrual adjustments. So for example, in this example, we have accounts receivable. The beginning accounts receivable was $205, and the ending was $150. So that accounts receivable decreased, so there was a change of a negative $55. I've been giving the example all along here has been the crops held for sale. So on this, last year, January 1st of 2019, this farm had $50,850 worth of crops on hand, and this year they carried in $69,000 worth of crops. So they had a gain here in their accrual adjustments of $18,150. So we add up all the accrual adjustments plus the cash from the farm income, and we come up with a gross farm income, considering the accrual adjustments, of $686,892. I did not say that right. All right. And then the cash farm expenses, this is identical to the one that we saw a moment ago. And then we have accrual adjustments. So for example, last year they carried in $67,000 of fertilizer, and this year they're carrying in $50,000 of fertilizer. This is going to be a positive $17,000 on the accrual adjustment here. And then we add these accrual adjustments along with the cash expenses that were on the previous slide, and we come up with cash farms expenses of $567,000. So when we subtract the business receipts, including the inventory changes, less the farm business expenses, including those changes, we come up with the net farm income. So accrual adjustments, should they be positive or negative? This is actually a slide that I would say put a star on and come back to it, because this will be something that will you'll want to think a little bit about. When you're making your accrual adjustments, think about whether the changes from the beginning of the year to the end of the year, does that ultimately increase the value on your farm? Does it make it better or worse on the adjustments for the income and expenses accordingly? So for example, if you had more inventory of crops on hand at the end of the year than you did at the beginning, that difference is added. On the flip side, if you have more inventory of supplies on hand at the end of the year than you did at the beginning, then you deduct that expense. That is something that it feels like you need to think a little bit about. What it is because those supplies are actually an expense. So you've got more on hand, but you also have more dollars wrapped up in that supply. So we know that this is a little bit hard to follow, and we want you to know that in our examples, all of those are in there correctly, along with the reading material in your book, and follow those formulas until you get comfortable with that, which direction those are going. So now let's layer onto the income statement depreciation. Depreciation, is something that we talk about frequently on our Schedule Fs. The depreciation we're going to talk about now is going to be different than what you're doing on your Schedule F. On your Schedule F, when you're doing some tax planning, you are likely doing possibly some bonus depreciation where you're accelerating the depreciation, and take that off as a tool to manage your taxes. What we're looking at here is more the economic impact, and recognizing the loss in value due to wear and tear. So an example of a straight line depreciation is if you purchase a truck for $40,000 and you think that it'll have a life on your farm for 5 years, and at the end of that 5 years you believe that you'll have $10,000 left, or you'll be able to sell it for $10,000 at that time. You take the original purchase of $40,000 minus what you believe the salvage value will be of $10,000, $30,000 loss in value. You believe that you'll have it for 5 years. 30,000 divided by 5 years, that's $6,000 of depreciation per year. Now, to compare that to what you might do on your taxes is if you purchase a truck for 40,000, your accountant may help you to come to a decision that maybe you want to bonus depreciate the whole 40,000. That's why these things are going to be a little bit different. Just remember, for what we're doing right now, we're looking at the asset value decline for wear and tear. So some ways that we can look at depreciation is you can do depreciation looking at the actual market values of that asset from 1 year to the next. We talked about some ways that you could do that last week. Another way, and this is how we handle it on our balance sheets when we're working with farm families, is we take a specific reduction. So how our computer system handles it is we do a 10% decrease for machinery and equipment and 5% decrease for buildings. And that's what we're going to show you in this example, is to do, those are the depreciation levels we're going to do. So that's how we're going to handle that here. So just recognize that the depreciation is going to be different than what you're doing on your taxes. So this slide looks identical to the slide that you saw before. We have the cash farm income plus the accrual adjustments to get to a gross farm income. Again, identical slide, cash farm expenses. And then this slide at the top is very similar to what you saw before. We have those accrual adjustments added to the cash farm expenses to get to a net operating profit. And then you'll see where we do depreciation. So this farm has $465,000 worth of machinery on hand. 10% depreciation is $46,504. Likewise, the buildings, that is a 5% depreciation number. Add those two numbers together for machinery and buildings, we come up with $47,000. We take net operating profit of $117,904 minus depreciation of $47,000, and we come up with a net farm income of $70,128. Remember, depreciation is not a cash expense. It's not an inventory item, but it does recognize the wear and tear of what your machinery and buildings are decreasing by each year. So this is that same slide we've seen before. Farm business receipts, cash income, plus inventory changes, and then subtracting off the farm business expenses, including depreciation, to get to the net farm income. This is ultimately what we would like to see you get to on your income statement. But if you're most comfortable doing one of those steps above, that is perfectly fine. And honestly, I think if you're doing any of this, you are probably ahead of 70 or 80% of the people out there. So I think that's my made up statistic, but I think that's probably accurate from what I've seen oftentimes. So we just talked about looking backwards. That's how we're looking at creating those historic income statements. So it's focusing on what happened last year and was I profitable. That's what we just talked about. The next thing that we'd love for people to get to is actually creating a projected income statement. So anticipating what those numbers will look like for the upcoming year. So anticipating, looking at your fields, what do I estimate my yields will be? What do I estimate my prices to be to come up with income items? What do I estimate my expenses to be? You can look at last year's to kind of give you an indication of what you think those might be for the upcoming year. And then thinking through what that profitability will look like for the upcoming year helps you to plan, also helps you with your marketing on when do I need to execute on sales, and makes that easier, in theory, makes it easier to make those decisions. So the question always comes up is, should personal income and expenses be included on the business income statement? The short answer is no. And the overriding reason I want to tell you no is because we're trying to get to the profitability of the farm. And we are going to talk a little later. You'll have the local presentation on the family living expenses where that piece will come in. But just overwhelmingly, we'd rather not have the personal side in this. So tips for preparing the income statement. We want you to prepare the income statement at the same time each year, and preferably with a beginning and an ending balance sheet. Focus on completeness. I mean, do your best. We know that this is a work in progress, but focusing on completeness and focusing on doing it at the same time of the year, and keeping this just reinforces that message from 2 weeks ago, that accurate record keeping is just vital to doing a good job with using these financial statements as a tool in your business. And one thing, focus on accuracy, because inaccurate financial statements might lead to a false sense either of security or that things are worse than you think. So record keeping, I mean, that just continues to drive home the importance of record keeping there. So I am going to switch to Robin, and we'll move on to the next part of this.
All right, thank you, LaVell. So what I'm going to cover is, now that we've put together an income statement, what do we do with it? What's the use of it? How do we analyze it? So what we typically think of when we look at that bottom line number of net farm income, that's our profitability for the year. What can we do with it? What do we use it for? Well, the biggest thing we look at, reinvestment into the farm business. And this is typically making your principal payments on your loans. In your expenses, you're going to see interest on loans, but you're not going to see any principal, because this is technically growing your business by investing in more equipment, land, cattle, anything like that. So sometimes we're going to use that to do principal payments. Sometimes we're going to use cash to make investments into our operation. So net farm income is used for reinvesting in the farm business. Paying income taxes. This sounds a little funny, but that's not an expense on your income statement. And the reason why really your taxes are dependent on your profitability. LaVell talked about some adjustments that we can make in Schedule F to manage our taxes, but bottom line, we don't pay income taxes in our expenses. Net farm income does have to cover those. The biggest thing we'll talk about, make a comparison of as well, is family living or the owner withdrawal. So typically on our farms that are sole proprietorships, we don't actually pull a wage for the owner operator. What we do is live off of what we're making on the farm. So what we're pulling out of the farm to live on, in a way, can be considered the owner's return, the owner's wage for operating that farm. So we need to make sure we have a net farm income to a level enough to support that family living or owner withdrawal. Now, there's some things that you can analyze your income statement for. If you have been doing income statements in the past, or now that you're going to start and do them into the future, you can look at trends. Each year, is your profitability about the same, increasing, decreasing, consistent, or volatile? Benchmarking, I'm going to show some things here, how you can look at other farms similar to yours and see what income levels they are at. And then some ratio analysis that we can do on those income statements. So we're going to circle back a little bit. The first night you saw Michael actually present this slide. And what this is the net farm income for our Kansas Farm Management Association farms in 2017 and 2018, and just showing the distribution of where they're at. Just to kind of give you some context, this is over 1,000 farms here in Kansas with an average of 2,400 acres and 1,600 of those being cropland acres. Now there's a huge variability around those numbers, but just know that's the average size operation. So you can see in here that we have a lot of farms in this middle area here that are $0 to $50,000 net farm income in 2017 and 2018. We have 21% of our farms in 2018 that actually had a loss. So their bottom line number after economic depreciation was a $0 to $50,000 loss or more. But we have a number of farms that had higher net farm incomes, even upwards of 30 or 300,000, 400,000. So there's a wide variety of profitability in our operations here in Kansas. I want to actually take this back further. So I'm looking back to the 1980s. I'm sure a lot of you remember why we talk about the 1980s and the farm crisis then. And so back then, our 10-year average was about $18,000 of net farm income. Since then, we've climbed up. The one for the 1910 the average looks pretty good at 115,000, but you'll notice that jump between 2014 and 2015. This was the biggest drop in net farm income that has ever been recorded within KFMA. So that average is very misleading. It was fairly good profitability until we hit 2015, and that average number was about $5,000 in net farm income. Now you might say, well, we have had everything's more expensive now than it used to be. So let's adjust this to 2018 constant dollars. You'll see back in the 1970s, now we go back even further, we had some really profitable years. I don't know who remembers 1973. I don't. I was not alive then, but that was probably the best year we've ever had in farming. So some of you may remember that and why that occurred. Then we go to the 1980s and you can see that huge drop as far as our profitability. We've climbed out of it some. Again, we had some good years here, 2010 to 2014, and then we've had some really rough years. The last few years are really being bolstered by those MFP payments. Now, you're going to have a whole discussion on family living expense coming up, so I'm not going to really get into that too much. But just know in our KFMA association, this number is about $70,000 annually. So this is money that the family needs to live on for a year's time. Okay, so let's get into some ratios now. You can benchmark against those other farms if your farm kind of matches that criteria, but you can also look at your operation and just say, are expenses and income in the right balance? And the way to do that is looking at expense ratios. So I have 4 of them listed here: operating expenses, depreciation expenses, interest expenses, and then what is left over is your net farm income. So these always add up to 100%. You can think of, for every dollar of revenue that comes into your business, where did it go? So just to show an example here to kind of drive that point home. So for every dollar that came into the business, 72 cents of it went to pay operating expenses, 6.8 cents went to depreciation, or what value your assets are losing year to year, 6.1 or 6 cents went to interest expenses, and then 14.5 cents were left over for net farm income. So again, that sum is always 100%. And you can just say, well, of the dollar coming in, where did it go? So what are good numbers for these? I included the formulas in your printout. I'm not going to actually go through these, but just so you know background, how these are calculated. You just take the total farm revenue, that top number that LaVell was showing, and divide it by the different pieces to get these ratios. Now, what are some good rules of thumb? So when you think about this very crudely, it's the 60-10-10-20 rule. 60% for operating expenses, 10% for depreciation, 10% for interest, 20% for net farm income. But we can dive into this a little more specifically. So you want 60 to 70% for operating, 4 to 10% for depreciation. That's a fairly big range there. 8% or less for interest. You won't want to be paying a whole lot of interest, or that really drags the farm down. And then 20% or more for net farm income. And just note, these rules of thumb are reflective of a traditional operation. That's a crop livestock operation. Some of the other viewers out there, I know you're more horticulture, vegetable, CSA production kind of thing. These probably won't hold for that type of operation. But in general, for our Kansas traditional farms, this is a good rule of thumb. Now, I showed you some of these graphs last time, and this gets into the benchmarking again. What I want to show by looking at these ratios and this distribution is just that these rules of thumb are good, but our sign of the times is kind of dragging these ratios down a little bit. And that's not anything to say that there's some operator errors out there. It's more what we're seeing is, as we have lower prices, that revenue number is lower, but the expenses are the same. So naturally, like I said, these have to equal 100%. Your expense ratios are going to be higher compared to your net farm income ratio. So here in this operating expense graph, again, the blue is a 10-year average of Kansas Farm Management Association farms. The orange is 2018. We won't have 2019 available for a couple months yet. So an average in 2018 was an expense ratio about 72%. A large number of our farms were getting closer to 80% in 2018 compared to the 10-year average. That was closer to 70%. Again, looking at our bar below here, you can see strong is 60% or less of your revenue spent on expenses. Getting vulnerable is above that 75%. So we have a number of farms that are in a vulnerable position, even in the 10-year expenses. Now, I did skip depreciation and interest just because we don't have time to cover everything in detail, but let's look at net farm income. And again, this is what's left over after you pay operating, depreciation, and interest, what's left over for net farm income. And as I said, ideally, by our rules of thumb, we want this greater than 20%. And that's where you can see this green bar. If we're getting less than 10%, that's a vulnerable position. You can see in the blue, a lot of our farms in the 10-year average are about 30%, which is a really good position. We're starting to slip a little. That 2018 is flattening out, and we're just seeing a number of farms that are struggling. Some of them still doing good, but just a lot of volatility out there as far as what net farm income levels we have. All right, to wrap this up and get you into your hands-on activity, start with creating a historical income statement. And as LaVell walked through there, starting simple and then working your way into the accrual adjustments and the depreciation to really drive down to an accurate picture of your profitability. Be consistent with those accrual adjustments, making sure you're adjusting for the same things, making sure you're doing your balance sheets the same way every year. And then working into a projected income statement going forward so we can look and be prepared for what our profitability might be in the coming year and make some adjustments ahead of time. So using this income statement to set parameters for your financial decisions, knowing your farm's financial position, and using this information to guide your decision making. Okay, so we are going to open it up for questions now. We're going to take questions for about 10 or 15 minutes here. And just be aware, there are 32 sites out there and almost 700 participants, so we will not get to every question. But go ahead and type them in the chat, and we're going to answer them as we can. And just know, anything we don't get to, we will type all those answers out and have those emailed to you by the end of the week. So LaVell, I'll have you slide back in here and we will open it up for questions. And host sites, when you're asking your questions, just go ahead and send it to everybody. Who gets to be the first one? Okay, Amanda, how many farms are in KFMA? There are roughly over 1,200 farms in KFMA. Some of them are different size farms, and we isolate down to kind of the normal traditional ones. But yes, there's 1,200 farms within KFMA, and next week we're going to have some information on what KFMA actually is and what that service can do for your operation. Darrell's question, what size of family for $70,000 of family living expenses? There's actually a handout in your packet that has the 2018 Family Living Summary Report for the KFMA farms, and it is broken down by the number of children in the family, of couples, and I believe even singles, and then the average. So you can go in there and look at those different demographics and what their family living expenses are.
So there's a question about some other expenses or some other income items, such as timber sales on a farm, and that could go into the other farm income. On anything like that, we'd encourage you to work directly with your accountant to make sure that how they're handling that. But that would be a good example of something that could be handled as an other farm income.
So a question here on health insurance and why we're not including it. That is really a family living expense. So we have talked ourselves. I actually wrote a paper last year on how that health insurance expense is increasing over the last 10 years and recognize that as part of that family living expense. So later on in the local discussion, you might to get into that a little more.
And I guess health insurance could be a benefit that you might be paying to your employees, and so that could be recognized as a labor cost, a labor farm expense. But that would again be working closely with your accountant to know where that would be falling into. There's a question about creating the projected income statement and how do you account for weather or open cows and so forth. So, you know, you're not going to be 100% accurate. I mean, just think about 2019 and how brutal so many things were. When you're creating the projected income statement, you know, you're really going to have to break it down into, let's just say that it's a crop farm, for example. You're going to have to be thinking about what are our average yields for the various crops that we're raising, and then what are price levels that we think that we can anticipate for that. Obviously, you're not going to know that information. That's a historic part of it, but make your best guess on what those might be. And when you're looking at yields in particular, and looking at the whole entire farm, there's times where sometimes those things come in a little closer than you might expect that they would, when you're looking at them for year after year.
One of the questions that came in asked about how, if you have a farm and a personal account, how do you pay yourself out of your farm account to your personal account for family living expenses? One thing that we kind of recommend is just, as you're setting a family budget, like just taking a amount per month out of your farm account for family living and then living on that budget. It makes it a little cleaner than just pulling money every time you need some money in your personal account. So that way you're kind of consistent on what you're spending, and account and being able to account for that in your farm cash flow. So we're going to get into that a little more next time. Sorry, we're scrolling a little bit here.
One of the questions is, how do you assign a value to the crops held for sale? So that is addressing anything in inventory that would be left held over. So one thing you're going to want to think about is, do I have anything forward contract that I know what the price level is going to be on that? If I don't have anything forward contracted, then what is a good average price that I'm anticipating receiving? So working with your local places that you're going to be delivering on, and at some point you just have to assign a value there. You may have some differentiation in the price levels. For example, if it's stored in an elevator versus stored in your own bins, those may be different price levels that you're considering, but you are going to have to just look at that on a case-by-case basis. So.
All right, they're coming in quick now. One of them on the beginning inventory, how do you come up with a price? This is kind of close to what LaVell was talking about here. You know, on the day you're preparing the income statement, do you take an average of the previous year? You know, this really drives home the importance of preparing these at the same time every year. So on your balance sheet, that's why we're recommending, you know, January 1st, you're consistent year to year then, and you're valuing those at the point in time that you could sell them for today. So you can see if there's some price fluctuation between years that actually will affect, you know, your adjustment in that crops held for sale. But just preparing them at the same time every year will help with that.
Yeah, and Darrell has a question here about using the last 3 years of Schedule F to determine the expenses when you're looking at your income statement. And honestly, that's the way that I do it oftentimes when I'm working with a client. And one good example is repairs. If somebody looks back at last year's repair, almost everyone says, well, just last year was a really high year for repairs. But if you look at 3 years, you can usually get a pretty good average, because you might have had 1 year that was really high, maybe something that was a high expense, and then maybe the other 2 years weren't quite as bad, or maybe just repairs were a lot more expensive than you kind of think they are too. So I like doing a 3-year on the expense items. That usually captures pretty well what you might spend.
Shonda, you have a really good question here, and I thank you for asking that, because I forgot to mention that. So the accrual adjustment lists market livestock. How are we accounting for the value of breeding livestock? So breeding livestock is kind of like machinery and equipment, where it is you know, something you're using to generate income. It's not necessarily the product that you're selling. And so we don't adjust for that in an operation that's remaining consistent. So if we have a herd of 100 cows and that's consistent year to year, we're not adjusting for that. We are also not depreciating those livestock, because in this operation, we're assuming that they're raising their replacements. Now, if it's an operation where you are purchasing your replacements every year, there's going to be depreciation, because like that truck example, you purchase them for a certain amount, you use them for an amount of time, and then they have a salvage value as a coal cow. So you would account for that in depreciation. But yeah, the accrual adjustment is just on the market end of the livestock.
There's another question here about hunting leases and whether or not how that comes into. Once again, work with your accountant to make sure, but I think I would probably consider that as an other farm income item. But do make sure that you're working with your accountant on that.
All right, a question from Rachel here. If you have equipment purchased on operating or capital leases, how do you show that on a balance sheet? One thing your book actually does at the end of their balance sheet is account for capital purchases and capital sales and make a capital adjustment. And we don't actually do that in ours. And that's because kind of in Kansas, it's recognized that net farm income is that income number before you make any capital purchases or sales and doing a capital adjustment. So, you know, when you can look in the book and see how they're doing that there, but what we're looking at, and the industry standard here in Kansas, is looking at net farm income that is an amount of money that's available to make those purchases. I guess on the lease situation, to kind of expand on that question too, if it's a lease situation, that's another thing you need to talk to your accountant. You know, is it a straight cash lease or is it a lease to purchase?
Yeah.
And that is accounted for differently.
Yeah, so on those, oftentimes that might be a machinery lease. So oftentimes when I'm working with a client, we may be working with their banker as well, and it may be what the banker actually allows them to do on their balance sheet. Oftentimes, we don't, we're not accounting for that machinery item as an asset on their balance sheet because they truly don't own that machinery item at that point. But we're not capturing the expense. It's not being captured as an intermediate liability either. It's actually being captured in the cash flow as an expense to the business that they're paying. Now, if it's a lease to purchase, sometimes bankers will allow you to capture a portion of that asset item as an asset on your balance sheet, but maybe not the full amount. So some of that is how you capture it. Some of that is how what your banker is going to allow you, how they're going to allow you to show it there. It is a good point, though. You do want to make sure that you have a notation that is something, so it just doesn't get lost in the shuffle of everything else. So.
On the Douglas County swine one, if you could give us a little more clarification on what you're asking there. I guess I'm a little confused on that one. Why don't we answer one more and then get to the activity? Okay. So our last one here is, why don't you recommend paying yourself a wage?
So the way that we're so it may be for example, on an LLC or corporation, they are probably paying wages to abide by what is set out for what they are supposed to be doing. The way that we are showing this cash flow, the way that we are showing this income statement, the bottom line number at the very end, that would be what you would have left over to either invest back into the business or to use for family living expenses there.
Yeah, I guess just to emphasize there, a lot of our operations as sole proprietorships, they can pay their wages are what they make. So they can't always pull the same amount every year because the profitability might not support that. So a lot of our operations, we're kind of showing a sole proprietorship in that, this is what their income is to live on for the year. But in different operations, you would want to pay yourself a wage. Okay, I'm going to get you going on the activity here. We want to make sure that you have plenty of time to do that. So,
and while Robin's switching slides, this is just a reminder once again that we will capture all of these questions this evening, and if you feel free to add more if you want to as we go along this evening, and we will get those put together with the answers and then sent out to your host locations, and then they will send those on to you prior to next week's session. So.
Okay, activity time. So again, the goal of this activity is for you to not just listen to us, but to apply what we're talking about to an actual case farm situation. So we're going to have you pull that out now, and we're going to have you work on it for a while, and then we'll come back and go over the answers. So depending on what farm you're using, you may have Joe and Jean Farmer or John and Jane Gardens. And what they're going to do is you have the same balance sheet that you worked on last time matched up with a balance sheet from January 1st of 2019. So you can see how their inventory levels have changed within a year's time and do some accrual adjustments to your income statement. So you'll want to pull out a beginning-ending balance sheet. You are going to have a narrative to go along with your income statement, and then you should have an income statement with some blanks. So feel free to work in groups, work through that narrative, fill in the blanks, and then answer the questions and do some discussion of those questions within your group. And we will come back on in approximately 20 minutes. All right. Hopefully you had a chance to work through that activity and discuss it a little bit with your group. We're going to go over the answers here. So our livestock and milk cash sales there. listed at 141,045. The crops held for sale and feed. Again, I went over those changes in inventory. So we have a positive, we have more income because we have more stuff in inventory at the end of the year than we did at the beginning. So that is our gross farm income there of a $686,892. And then our expenses, I just gone through that. That was a fairly easy one, fill in the blank. And then the accrual adjustment for fertilizer and supplies on hand. So we actually decreased the amount of fertilizer and supplies that we had on hand. We used up some of those resources for expenses. So we're actually going to add that to our expenses here of a $17,305. So that is our accrual adjustment. We add that to our inventory change, and then that gets added to our total cash farm expenses. Now, the next question asked about what's the net farm income. So to derive this, you just take the gross farm income, so the total amount that came into the operation after the accrual adjustments, minus the total cash farm expense after accrual adjustments, and that becomes your net operating profit. From there, you take off your depreciation. And just to emphasize here, again, this is not the depreciation on your Schedule F. There was a question we didn't get to that asked about Section 179, and that's the accelerated depreciation that you can do on your taxes. We don't want to put that here because that distorts the profitability of the farm. That's a tax management kind of depreciation. Here, like LaVell explained, we're taking 10% of machinery value on January 1 and 5% of the building value on January 1 and assuming that as depreciation. So that's actual loss in value of those assets. You know, by owning those assets, what we are tying up capital that we could do something else with. So, you know, the loss in value of those assets is a expense to our business. Now going on to the questions. So without considering depreciation, how profitable was this farm? Well, as I just went through, if you took the gross farm revenue minus the total cash expense, and those are both accrual adjusted, you get $117,904. This is also called the net operating profit on the income statement. Now, for every dollar of income on this farm, how much is spent on operating expenses, not including interest? When I went through this expense ratios, remember I did operating expenses, depreciation, interest, and then what's left over for net farm income. Why do we separate out that interest? Just because it's a key piece of information to look at and how much you're spending on the financing of your operation. So here we're looking at that operating expense ratio. And again, that question came in there. This is the total operating expenses after accrual adjustments before depreciation, but you're adding back in the interest. So we get 76% or about 78 cents of this. Every dollar coming in is spent on operating expenses. Now, just to expand on that further, if you think of that out adding up to 100%, so roughly 7 cents of every dollar coming in is spent on depreciation, 6 cents on interest, and a little over 10 cents is left over for net farm income. Now, the next two were discussion questions, so there's not any one right answer to answering these. So what was the net farm income? Was that a good amount for this size of farm? So we're going to look at the net farm income ratio, and that was about 10.21%. So for every dollar that's coming in the farm, you have 10 cents, a little more than 10 cents left over for net farm income. If you remember back to our rules of thumb, we want 60 to 70% for operating, 4 to 10 for depreciation, 8% or less for interest, and then 20% or greater for net farm income. So we're quite a bit below this good rule of thumb or this benchmark number when we're looking at a net farm income ratio of 10.2%. Now, if you think back to my benchmarking graph, though, it's kind of a sign of the times to see a net farm income ratio of this amount. So that would be right about here on the line of vulnerable. But we're seeing a number of farms that are dipping into a very vulnerable position, even a negative net farm income ratio. So this is not uncommon. for the sign of the times, but just know this is probably not a sustainable level. And that's what the second discussion question got into. Will the farm be able to pay their principal payments, support family living at this net farm income level? And just note, the operator is not being paid in this operation, as we kind of got that question on. So there's going to be a lot of moving pieces to this, and I'm going to approach it two different ways. So one way to look at it is how much cash is available to cover those principal payments, family living expenses, and income taxes. So our net farm income is a little over $70,000. We can add depreciation back in when we're thinking about this, because we're looking at how much cash is available, and depreciation is not a cash expense. So that gives us $117,904. Looking at their balance sheet, this is kind of trying to connect these statements together and make you think critically on this. Remember, they had about $72,000 of principal payments they were going to need to make in this coming year. So if you take that 117 minus 72,000, that leaves about 45,885 to pay family living expenses and income taxes. As you saw before, our average family is around 70,000, so that's not going to be enough. Another way to think about this, and this is really getting into the nitty-gritty, so if I lose you here, don't worry. The second way is just to look at, okay, net farm income level of 70,000. That roughly matches the average family living expense in that KFMA database. So if there were no other needs for this farm, that 70,000 is fairly balancing out with maybe the ownership withdrawal or the family living expense. Now, when you look at depreciation, though, I talked about this being a non-cash expense. But what you need to do to keep your equipment line and your buildings at a constant state is be reinvesting that depreciation dollars back into your farm in making those updates to that equipment and buildings. Now, repairs is an expense, so we're not talking about that. We're talking about keeping that equipment up with the times and consistent. So in this farm, they actually are paying some principal payments on an air seeder and a tractor loan. And this year, that's going to be about $36,000. So they're not quite leveling out with what they have in depreciation on their machinery and equipment, but that's okay. There's going to be some year-to-year fluctuation on that. But also notice they're growing this operation by investing in land and bred heifers, and this net farm income is not large enough to support that. So again, that's really getting a bit down into the weeds, but for those of you that are familiar with income statements, you can kind of look at those pieces a little more critically. The bottom line is 70,000 is going to leave this operation short. So hopefully they have some cash reserves or some outside income that can make up that difference. Next week, when we get into the cash flow statement, this is where we're going to be analyzing that question. And just to show, when you look back at my net farm income graphs from earlier, what's going on around the state, this really shows why those MFP payments, marketing facilitation payments, have been helping keep farms afloat from year to year. We've gotten those for 2 years now, and that's really making up the difference of where we're coming up short in profitability. So with that, if you want to do this yourself, and we highly encourage you to do so, there's a blank version included in your packet if you want to do something by hand. There's also an Excel version found on agmanager.info under the decision tools. Now, I want to touch on one topic here quickly before we have you break into your local discussion, and that's enterprise budgeting. So if you're looking at your net farm income and saying, this isn't the level I need it to be at, what do I do? One thing you can do is diving into what segments of your business are making money and what segments are not. So really breaking down from a whole level profitability to a enterprise level profitability. So I just threw up some numbers here for corn, soybeans, and wheat. And no, this is not reflective of any one operation. This is just an example. So in the coming year, this farm is looking at an average yield for corn of 120 bushels, soybeans 41, wheat about 50. They've got some projected prices there of those commodities, which gives them a total return per acre. Now I'm going to dive into their direct and fixed expenses in a minute here, but if you just look at the returns on the bottom, you can see that this operation would be projecting a $46 return per acre for corn, a $48 per acre return for soybeans, and almost a $63 loss on planting wheat. So this is just, as I'm talking about enterprise budgeting, this is crunching it down. This is what we're doing, is trying to evaluate each of those pieces separately and looking at the bottom line number and where we're making money and where we're losing money. Now to get into that, I know you can't see this very well, so I'm actually going to flip over to showing you online where these crop budgets are at. Give me 1 second here. Okay, so this is our website, like we've showed, agmanager.info, and here we have farm management guides is what we're calling them. And we have some for non-irrigated, irrigated, and then livestock. So what I'm going to do here is just pick out a budget for corn, and I'm going to try to keep this as big as I can so that you can see the numbers, but at the same time follow along here. So what this does is, what I showed as an enterprise budget is breaking it down to the pieces. So you can see the price and the quantity that I was talking about, and then the revenue. You could account for some government payments. You know, as you're getting into wheat and looking at PLC, you probably can put something on there for some of your commodities that you know there may be payments in. And then here we have your direct expenses of fertilizer, herbicide, seed, crop insurance, miscellaneous expenses. How we account for equipment is through custom rates on this. So each operation that you're doing, charging a custom rate to do that. And then any additional labor, some management work and things that don't involve equipment, so charging something on there too. So then you can see your total direct expenses of $342 per acre, or $2.85 a bushel on the bushel level. The fixed expenses we have here is just a cash rent. You may not be planting all your ground on rented ground, but there still is a cost. If it's your ground, you could rent it out for $61 an acre in this example. So it's kind of like an opportunity cost if it's your own ground. And then getting to the total specified expenses of $403 per acre, or $3.36 per bushel. Just to note, if you're trying to find your break even, so when we talk about, you know, looking at your cost of production, your break even, this $2.85 over your direct expenses, or $3.36 over your specified expenses is your break even. This is what it's costing you to produce a bushel of corn. And you can use that information when you're making some marketing decisions of what you need to sell for to actually make money in your operation. And so then here in this budget, it shows you the returns over the direct expenses and the total specified expenses. Now, again, I'm going to go back to our website here. These are available in the Excel format and the PDF that I just showed. So we have a number of different crops and different regions of Kansas that you can start from, but I really encourage you, you need to make adjustments to those expenses specific to your operation, because your expenses may not be the exact same as what our average for that area is in these budgets as default numbers. While we are on Ag Manager here, I just want to point out a couple of resources that people have been asking about. In our land leasing section here, the first thing we have is land buying and valuing. A lot of you asked about land, what land's worth. There's a number of resources here, but every year we put out what we call the Kansas Land Values Book. 2018 is the most recent one here. We'll have the 2019 coming out the next couple months. And these are at the county level, region level, and state level. And there's also some here for cropland and pasture at the county level that Michael Taylor puts out. So a number of resources there. Another thing a lot of people are asking about right now is ag policy in the 2018 Farm Bill as you're making your program elections between now and March 16th. We do have a lot of resources too devoted to making that decision. and that is actually an area of specialty that I work in as well. So just know this agmanager.info is on the bottom of every one of your slides. That is our extension website for farm management. So feel free to go there and look up any of the information that you might be wondering about. So with that, I am going to switch back to our PowerPoint, and we'll keep rolling here. Sorry, technical difficulty here where I find where
enterprise budgeting.
Okay, there we go. All right, I'm going to turn it over to LaVell for some announcements, and we're going to shut off and let you do your local presentation.
Okay, so next week is our 4th session. I can't believe we're rounding up on towards the end of this. Next week, we will focus on cash flow. That will be the financial topic that we talk about next week. And then we are also going to talk about some goal setting and some things that you might be able to do on your farms. So that's what's going to be coming up. We continue to encourage you to network with the other folks at your location and continue those discussions, because we've heard just some really wonderful, wonderful feedback. In your folders, you have that My Personal Action Plan. You've done it a couple of weeks now, but we do want you to choose one thing that you learned tonight, an idea, and try to implement that before next week's session. So an example might be that you'll create a historic income statement for 2019 before next week's session. We also encourage you to choose 2 other action items and try to accomplish them by another timeline. Maybe not next week, that might be a lot, but perhaps creating a projected income statement for 2020 in the nearby time frame. So once again, this is what your personal action plan looks like. You've got your takeaway messages. What were 3 things that you learned tonight that are important? We know that writing things down helps cement that in our mind. Writing down a couple of action plans, and then the timeline along with that. And please, we've mentioned this before, but this is our first time to do a series like this. So if there's anything that we forgot to mention that's important, please make note of that. We'll be gathering these next week. And we'd love to hear your feedback and any additional comments that you have. We know that when you're at these types of meetings, sometimes you get busy and you're ready to go home, especially when it's cold and dark. If you don't take time during these here at the end of this evening, please at least try to fill out this personal action plan between now and next week and have it as complete as possible. At the end of next week, we will collect the yellow copy, the carbon copy on there. And part of that, the reason that we're going to do that is because our funding, a large portion of our funding came from a grant from the North Central Extension Risk Management Education. And they do require that we give them feedback of what people learned, what are they going to implement, and things like that. And without that resource, we would not be able to provide this education like we are. We also have some wonderful statewide support. As we mentioned earlier tonight, Central National Bank provided funding to provide the additional books, the additional 200 books that for the additional registrations, which we're so happy that we have. And then Farm Credit Associations of Kansas also has provided statewide support, and we'll see that a little more directly with something for next week. We do not want to forget, we have some wonderful local sponsors who have been sponsoring your meals and some of the other things at your local sites, and we really appreciate everybody who has stepped up to support this program. If you have any questions, please feel free to reach out to Robin or I, or go onto the Ag Manager website. And with that, we are going to break from you this evening, and you are going to work on a local activity with family living expenses, and we will see you next week. Thank you very much.
Thank you, and have a good night.